the common theme is very much just I don't know what to do with these books. I'm just doing the best I can to get through the
Yeah,
tax
they're
return
flying blind.
process. They're flying blind.
Hello, everybody. Welcome back to Commercial Real Estate Secrets. I'm your host, Austin Hare. Our guest is Mike White. Mike White is principal at CLA. It's the 8th largest CPA and consultancy firm in the country. They focus on dentists, physicians, DSOs, med spas, veterinarians, orthopedics, and ophthalmologists. So almost anything in the healthcare space. And they've been crushing it. And so, Mike, it's a pleasure to have you on the show today. Thanks for coming on.
Hey, thanks for having me. Great to be here. I've watched your videos online on LinkedIn for so long, so good to be on the other side of it.
Cool. Yeah. Well, I'm glad to hear somebody's watching them. So, um, yeah, let's get to know your story a little bit. So, how you live in Dallas right now, I know. But like, were
Yeah,
you from there? Like, what was childhood like for
yeah.
you that, shaped who you are today?
Wow, this we're gonna get deep today. Yes, grew up in Garland, so north suburb of Dallas. My father's a band director, my mom's a nurse, and we just knew hard work. We've been working since we were 12, real jobs, not under the table stuff at 12, I guess. About 14 is got my first real W-2 paycheck or whatever. And all I've known is work, right? So the work ethic was strong, and when I went into school, did my undergrad and grad at Texas Tech out in West Texas. Married my high school sweetheart, both of us CPAs. And really, what I realized fairly quickly is I'm not a great employee, so I always wanted to make sure I had a path and had that entrepreneurial spirit. So
How did you
I
realize that?
started my first CPA firm. Yeah, I think it was the fact that I kept kept getting in arguments with my bosses or whatnot, and I wanted to carve a different path. And in the small world we live now, Austin, actually, it's funny. 3 doors down from us is my wife and I's childhood boss from J.C. Penney's.
Wow.
Now lives 3 doors down
So
from
you're both
us,
CPAs
and
and you both worked at JCPenney's?
we did. That's how we met. That's how we met.
Oh, wow.
So
So,
it,
you just had, I don't want to say problems with authority, but essentially you wanted to do your own thing, right?
I saw there was opportunities to do your own thing, and I saw work hard and all that stuff. I always looked to my parents for that work ethic. And my dad, being a band director, works still more hours than I do on any given day. He works around the clock. It's a hard profession, but he loves what he does. And so I think that education side of what he did, but the hard work with little pay was something that I'm like, all right, I can do the hard work, but I want to make sure there's a compensatory side to that. And when I got to start to know some of my business owner friends and family friends and stuff, I realized there was this big disconnect in the accounting space where most CPAs are reactive to everything they do. They take the information they get to you, they may be 3 to 4 months behind, and it's still the story I hear today.
Hmm.
And that's really what launched our firm, right out of the gate in 2007, 2008. And kind of did some side hustle work from 2004 to 2007 while I had a day job. But in 2007, I really launched the firm and built it into, this focused industry. So
Yeah. So are you familiar with Keith Cunningham?
I don't know Keith.
Okay. He's a Tony Robbins, like I don't know, partner, I guess, and he speaks about accounting at a lot
Okay,
of their events and stuff. And that was like kind of like the
nice.
introduction to me to like real world accounting, and like the way that he explains things just makes it so
Yeah.
simple because it's like you say accounting and your eyes glaze over and like you don't want to hear it and you
Yes.
just want to kind of like pass the baton off to somebody else. But I mean, it really is
Yeah.
important to understand it. And I think we have a lot of
It is.
misconceptions about it. And what you said just now, essentially accounting is 3 or 4 months late. It's behind schedule because like, yeah, it's like you file all your expenses, then somebody has to look at that and process that. And then, meanwhile, you're operating your business, more transactions are happening. You
Yeah.
look and you can see how much money is in the bank account. And then 3 months later, it's like
Yeah.
you get a statement that says, oh, hey, you lost money last month. It's like, well, yeah, thanks. I know that. I can look at my account, I can see it. Or it's like, how do we fix that,
Yeah.
right? So is that kind of like the problem that you guys addressed?
It is, and I see this stimulate the accounting profession even before I got into healthcare as a focus. I stimulate the accounting profession as one that's just it's created itself and it's almost devalued itself in the eyes of so many consumers. Because I talk to people today, and we start talking about all the things that we are doing as a CPA firm, all the things that we are doing to help these practices, and it is eye-opening because at first they just think, oh, you just do my taxes, or you're the person who does an audit if I even need an
Mm,
audit. where we really talked about, no, we're here to help you tell the story of your business and then make decisions from that story. And that's what I've always utilized the financials as is, hey, this is the story. I mean, people are looking at this, whether it be a lender, a possible partner, capital event with everything that's going on in consolidation today. If we devalue the bookkeeping, then the people who are going to want to invest in us are going to devalue us as well. And we see it time and time again. And that's what we've really tried to change the messaging and help people understand that, yes, there's a cost to having a good set of books, but the cost and the value that's increased, it's always a multiple increase in that valuation, which is exciting to see.
So yeah, let's talk about that. Like what specifically? So
Yeah.
how did you transition accounting from being a lagging indicator to a forward leading indicator? Like what do you
Yeah.
guys do?
Yeah, great question. So a lot of it comes into our reporting and then the conversations. The
Okay.
team that we've built here at CLA are all former CFOs, COOs of medical and dental facilities, DSOs, people that have been doing this for 20 some odd years. So they understand the correlations between the information in your practice management system and the information coming from your CPA. So we're looking at doctor days work, production per patient, number of patients seen, collection ratio, cost per acquisition of every patient that comes in the door. We're looking at that granularity of details and helping us say, okay, this is what happened. These are the goals we set. This is what we expected to do. And ultimately it comes down to accountability. Who owns each one of these metrics within the practice to improve your goals? So while
Hmm.
we took it was first getting structure in the process. So a lot of our accounts, we were doing back office accounting. We're controlling everything from the revenue inflow to the accounts payable to getting the information from the payroll. So we had to put structure and timelines and checklists to that process. And that way, accountants who are very task-oriented people by trade and by profession is very much around, this is what I need to do. Great, I have a deadline, I can do it. So what I realized in the profession and being a non-traditional CPA, but married a very traditional CPA, I realized it's that you get somebody a task to do, they will do it. But if you just give them open end, it's like, here's everything you need to do, then it just gets, muddled up and you try to prioritize. So we put a lot of structure to the accounting process.
Hmm.
It's
Okay.
one of the big things. Yeah.
Um, yeah, so another thing that they talked about at the DEO event is cash basis versus
Yeah.
accrual basis. And it seems like most people start out
Yeah.
with cash-based accounting, which just simply means
Yep.
that, when somebody pays you, an invoice doesn't count as a profit on your profit and loss statement until that doesn't matter, right? It's just about the money that hits your account. And then it's
Yep.
like also if you have an expense that month, even if it's a one-time expense for equipment that you need for the whole
Yep.
year, like that counts as that monthly expense. And so it's like cash base
Yeah.
is obviously it's just different, right? Like the problem with it though is that accrual basis, you would take that expense and you'd amortize it over a certain amount of time, or you depreciate over a certain amount of time, or when you get that profit, when you do the work, that counts as a profit on your books. And if you don't make it, then you have to reconcile it later. It sounds more complicated, but it does help spread things out because it's more or less like
It
consistent.
does.
So like, do people?
In the simplest terms, yeah, in the simple, cash, you kind of described it, but take this water bottle I'm drinking out of. If I bought the water bottle today, then that vendor is recognizing the cost of that water bottle. But for purposes of what they're actually doing with it, they may have bought it three months ago. So the cost was 3 months ago, but the revenue is this
Right.
month. So, from their standpoint, that's where cash basis doesn't really tell the story. Where in accrual basis, you're recognizing revenue as it incurred. Austin, you go to the doctor today, you see that dentist, they do their scannings, they submit their charges today. It's revenue recognition today, not when insurance pays 30 days from now. And that's the big disconnect. And I would love everybody to be on accrual basis financials, but it's that cost prohibitive nature. So people do start on cash basis, which is where you're saying they do start on cash basis because it's easier and we just want to get the foundation right. But what we tell people is even as cash basis, we still need to track accounts receivable aging. We still need to understand our prepaids. The big thing you mentioned was the equipment cost. We still need that to go to the balance sheet, not hitting our P&L, because part of that impact to EBITDA is depreciation, amortization, or add backs. So if we're investing in the business and growth, we don't want to take an expense on that and not get credit for it. So we really try to make sure that the capital expenditures are on the balance sheet and, expenses that are true expenses, benchmark, dental supplies, lab, advertising, things like that are occurring, then we recognize those as expenses as such.
Yeah, and it makes sense on the income side of things for sure. Why it's always
Yeah,
kind of lean towards accrual, especially in the medical
yeah,
business, where it takes a while, like from what time you bill. But there's certain businesses that are like cash businesses, right?
hmm,
Like in the restaurant industry.
yeah.
Is there anything? Is there any times
Mhm.
where you would just recommend doing a cash basis? Any industries or any point in the journey? Like if you just have one location, you're just starting out. Like it's. I mean, I know it's cost prohibitive,
Yeah,
right? But aside from that, is there any practical
yeah, for
reasons
sure.
to do cash basis?
Well, we call it a modified cash. So let's say we're recognizing expenses and accruing those expenses as they occur. So we definitely still do that. But take a restaurant that's revenue, it's revenue recognition. You're coming in, you're paying that day before you even leave. So you recognize the cost, you recognize the revenue. That tends to be a fairly consistent matter of, cash basis accounting, if you will. A lot of retail is around that. There's still accrual things you can do to really work forward on this, but for the most part, we tend to see things that aren't, 30 days billing in arrears, you know, that can be a little bit more based on cash.
Mm.
But construction's accrual basis, especially job costing, things like that. The real estate world that you and I live in as well, that's revenue recognition. That's a big accrual piece because, you may get 6 months of free rent. Well, you're still recognizing some type of deferred rent over that period until you collect the money. So it's interesting how that side's done.
Yeah, I've never thought about it in terms of accrual versus cash, because it's like you can measure your cash on cash return. You can also measure your IRR, like your
Right.
internal rate of
Yeah.
return, and it's kind of similar to doing a accrual basis versus cash basis.
Yep. Yep.
That's interesting. All right. So like, when
Yeah.
you start working with people or when people come to you, is there any, like, what's kind of the first, is there a theme of like first glaring
Yes.
problems that happen that you
Yes.
kind of can predict, or that maybe you could just help
Always.
people with that are listening in right now? Like what's the kind of the first thing that they can do that's going to help them the
Yeah.
most?
Always consistent theme. I actually had a new client call this morning. Great conversation. Sounds like an amazing business, but they haven't seen financials in 4 months, and that's a consistent theme that I hear. I haven't seen financials in a few months. I'm paying all my expenses out of one entity, even though I have 9 entities. So really, none of them are accurate. I'm expensing everything out in December, so that means even my 12-month trend is not accurate. So the common theme is very much just I don't know what to do with these books. I'm just doing the best I can to get through the
Yeah, they're
tax return
flying blind.
process. They're flying blind, and so that's what we really see. So what we always start with is let's do a free analysis. Let's see where you are and kind of map out what we need to accomplish. And heavily, we're doing some benchmarking to see, okay, not only can we clean up the books, but are there areas of accountability and just awareness? Like, hey, your dental supplies are 2 to 3 points higher than the industry average. Who owns that process?
Mm.
And what our goal is to pay for ourselves. I mean, we're trying to add value to that business owner right out of the gate. And that becomes a really critical thing for us to say, hey, we're not only going to help you tell your story, but we're going to increase your valuation of your business. And that's our goal.
So then,
So,
like ongoing, like what, you come in, you do the analysis and you identify some things,
yeah.
like how does it work ongoing?
Yeah, so what we're developing at that point is we're trying to understand, do they have an accountant on staff already? Do they have a couple people doing things that have they outsourced all of it historically, but they're at that point where maybe they need to bring an accounting clerk in house, or maybe they're wanting to think about a VP of finance or whatever level. So we're trying to assess: are they at a emerging group standpoint? Are they a mid-market DSO? Or are they a mature DSO? And I've seen all of it. I've seen the same problems at 50 to 60 locations as I've seen to 2 locations.
Mm.
So, you go back to the beginning of this conversation where we say, this has been a problem for decades. And, my goal is to get ahead of it. I got at least 2 decades left in me. So my goal is to get ahead of it. And eventually people are believing that the importance of the financials and the bookkeeping. But, back to your question, yes, our goal is to build that project plan. Usually it starts with cleanup. Let's get the chart of accounts mapped out to where we want them to be. They're consistent across all locations. Let's understand how we're allocating expenses. So if I have 3 locations and I'm paying one bill out of one location, but the other ones are also using marketing, then how are we allocating that? Is it by patient volume? Is it by just an even split percentage of revenue? Or is it more directly allocated based on the marketing initiative we had for that location? So we try to understand each one of those components of the P&L, as it relates to making sure day-to-day stuff going forward is right. Then we start building the timeline checklist, like when do you get your bank statements? When does your statements close? When do you want to meet on a month-to-month basis to make sure we're going over financials? And we back into does our team have to finish the accounting, and our analyst team have to finish the financial spreads and the models, and then when are we scheduling that meeting? And then, our goal ultimately is to become the first call that our clients make. Hey, Mike, I have a question about associate buy-in, or hey, I'm going to go get this loan, or somebody made a blind offer to me, or my hygienist just quit. I mean, what do we do in these situations? And we become that conversational piece from a development. So
Can you
we're prideful of that.
off the top of your head, without naming any names, can you think of a story or an example of somebody that you applied these things to and it just helped turn their business around?
Yeah, no, we had a great case, not naming names, but we had a great case that we came in, $30+ million revenue organization, but the financials were all over the place. There was 15+ entities.
Wow.
I'll use round numbers. 15+ entities. The books were all over the place, and EBITDA was negative, even though it was $30 million in revenue. So in 7 weeks, we mapped out here are the areas that we're going to focus on. They had a brilliant team, a great team of people that wanted to do right, just had so much stuff on their plate, and it was just a matter of narrowing down the focus. Great, we're going to tackle dental supplies first, and we're going to call our vendors, negotiate the supplies, negotiate all our costs, and we're going to push that out to the respective practices. Great. We're going to look at payroll next. Your payroll's 10% high as a percentage of income compared to everybody else. I'm not going to go from 10% to 0% overnight, but let's look at the high level stuff. What's going on with overtime? Holy cow, overtime's all over the place. They didn't realize how much overtime they had. So you start taking these measures, and within 7 weeks, we increased EBITDA $75,000 a month.
Wow.
And we already had a roadway to
month.
increase it $250,000 a month. And when you start thinking of multiple of 10 or 8 or 9, whatever it may be, for whatever investment they made, which was not nearly the amount of even 1 month of savings, it was less than half that. We just increased their valuation $10 million.
Wow.
And those are the kind of wins that you get excited about, right? Those are the kind of things that you really enjoy, and they're excited. They want to keep going. They want to absorb more. They want to move it faster. And you just got to keep on that cadence, though. You can only do so many things so quickly. And then some things take time. Some things take 12, 18 months. It's philosophical changes. And the biggest thing we don't talk about, Austin, is the financial, the support, the operational side of, hey guys, if all of a sudden you didn't care about numbers for 10 years, but now you do, what's that going to change in your culture, your dynamic? We've got to make sure we have that messaging correct.
So on the flip side of that, what's the biggest failure or mistake or learning experience that you've had on your career?
And so many. You're getting to know people, and I say that it's always a learning experience. I mean, I started a firm when I was in my mid-20s, saying, thinking I knew everything. So when you start that, you're there to learn as much as you are to educate. So I think a lot of things around what we do is, learning from our peers, learning from the legal side, the banking side, how we build things, and building structures and systems that make sense for the end users. And what we realized, and this was one that I recently really started to mold, is we built a lot of our stuff around scorecards, dashboards, budgets. And we realized as our groups were getting bigger, an evolution of our group as well, as our groups were getting bigger, that was just so much data to absorb for private equity and C-suite, individuals. They didn't need all the noise. So one of the big things we've started doing is okay, we have a now 1 to 2 location financial package. We have one that's 2 to 15, 2 to 20 locations package. And then we have the board reports, the private equity reports, the high level stuff to where they can run strategically. But I remember the first couple times that, we had this one client that just absolutely loved our scorecards. We've been going over them for 18 months. They had made so many good changes. They sent them to one private equity group that was excited about them, and they're like, this is terrible. This is too much stuff. Why are you spending all your time in all this noise? And it completely changed their perspective of what we had accomplished over the last 18 months.
Even though they had become way more profitable.
Yep, absolutely. So then what we did is we created 2 packages, one for the private equity group and one for, of course, the regional managers, the operations managers who still wanted that information.
Okay.
And so it was just a learning experience because
Yeah.
we had, from our evolution of taking groups from 7 locations to 30 locations, we were getting more of these that are going to private equity, more of these that are going to capital events, and seeing that perspective.
Yeah, that's smart. So depending on where you are in the life cycle of your business, you may need
Yeah,
multiple scorecards, maybe need
different.
multiple dashboards because if you're not looking to sell, you're not looking to recapitalize private equity, it doesn't matter. It's just all
Yeah,
internal. But knowing that
yeah,
that doesn't translate to a private equity group and then putting in the time to create those separate scorecards and dashboards is,
yeah,
yeah, that's,
yeah,
I think that's smart. So, um, what
yeah.
about like, in terms of the industry, what are some commonly held beliefs that you disagree with?
100% consolidation. I hear a lot of folks think we'll eventually get to 100% consolidation, and I'm specifically talking dental now. I hear that common language. Of course, we can say that in veterinary, ophthalmology, orthopedics, all these things that happen. But as we look to history and the consolidation that's been happening, I think there are a lot of people that believe we'll eventually be 100% consolidated. And I still believe that there'll always be the staunchly independent, the solo practitioner, the person who wants to do it. And of course, there will always be somebody who's wanting to start the very first practice,
Yeah.
right? And they want to start it on their own or whatever that may be. So I do believe we'll always have a place for the independent practices. Now, they may need to band together through associations and buying clubs and study groups and things like that. But at the end of the day, they're still independent. They still have their solo practice or 1 or 2 locations, whatever it may be. But I do believe as we look at that, we will continue on the consolidation path. I'd say we're somewhere in the 25 to 30% consolidated today, if I'm estimating. But I don't know that we'll ever get to 100.
Yeah. Yeah. And what's a belief that you've evolved your thinking on? I know it sounds like we kind of touched on this a little bit earlier.
It's a really good question. Oh my gosh, that I've evolved my thinking on. Well, one, you can always learn, and you can always learn from other people. I think if we start back to the comment of I was a mid-20s kid thinking I knew everything, I know I don't know everything. So, what I've loved about joining, my path of starting my own firm in my mid-20s to selling to CLA in 2018 and merging in, there was that evolution. I was 36, 37 years old when I made that change. And what I realized were the things my clients were asking for that we weren't there for them yet for. So we needed better technology systems. We needed better, we needed quality of earnings team. Sage Intact was a common conversation for us, what we were doing. So, when we've evolved into CLA, we've been able to get department heads for each one of those that are focused on consolidating industry. So they're knowing the industry, they understand the problems and challenges. So I can't do everything, and we've built an amazing team that can support us in that.
Mm, that's cool. So like where are the biggest bottlenecks when it comes to real estate that you observe, the people that you work with?
Yeah. I think the biggest bottleneck, so we go back to the evolution of a dental practice. The old adage is I want to have my bricks and sticks and I want to have my dental practice. I have my 2 entities. I own my building. I'm proud of the building. I can expand it. I can contract it, whatever I want to do. And now, as we get into this consolidating industry, the common conversation I have, and I'd love to hear your perspective, is do I do real estate with my DSO or do I not? And I think that's the big conversation. And I was on a presentation last night with a group that's doing consolidation right now, and they said, "What about our real estate? Do we form a REIT? Do we form something that acquires and tackles that need that we have of still wanting some retirement stable income or a hard asset?" Or do we just focus on leveraging with the practice itself? And that's where our conversations are. A lot of the multi-location DSOs I work with don't own the real estate when they're self-financing or borrowing the money because it takes away from their borrowing ability.
Mhm.
So that's what I'd see. But what about you?
Yeah, very very similar. What was just curious, like what was the outcome of the conversation that you guys had about that? You said it was last
Last
night.
night,
Yeah.
I think the redevelopment is going to be a definite thing that they should be looking at. I know some of the DSOs are starting to do those. It's a different set of investors that are behind them and stuff, but they are starting to build that platform in order to have a plan for these doctors that want to own the building or have owned the building and they want a place for their real estate.
So
So
yeah, so essentially they decided to go out, find a different group of investors that because you got
mhm,
your in that situation, whoever, whether it's, I don't know,
yeah,
bank debt or private equity or something like that, they probably have a
yep,
derivative, I mean, sorry, a directive to go
yep,
and invest in the operational side. And so then they need new people to come invest in the real estate side. And so, and also, it depends on how far along you are in the journey too. And then, like you said, development, are they doing de novos or are they doing acquisitions?
We see our book today about 50-50 on the folks that are doing de novos versus acquisitions. I would say it's shifting to more acquisitions. People are still actively trying to acquire their peers or try to, band together, affiliate with other practices. Austin, you and I are sitting here. I don't know how old you are, but I think we're both fairly young. The baby boomers that are happening today, we have 7 years before the average baby boomer is going to retire. Maybe extended a little bit because of COVID, but ultimately let's call it, 7 years. So there's going to be a lot of great practices that are going to need a place or a home. So, as opposed to trying to open and compete against them on a de novo basis or go into a city, real estate wise, where there may not be a spot for them, then they pick up the location and gradually convert it to their mission, their structure, their
Yeah.
story.
Yeah. And to answer your question about what we recommend,
Yeah.
like at the end of the day, like you said, if you got a limited amount of capital, bandwidth, and debt that you can take on, right? And so it's like if you
Mhm.
have to choose between investing in the real estate or investing in the dental practice business, like I think it just makes sense. If you look at it from a math perspective, like you're probably
Yeah.
going to make a better ROI reinvesting in the business, right? If you have
Yep.
the luxury of choosing and you can do both, then yeah, that's great too. And then also, a lot of times
Yep.
it just makes more sense to bring on new partners, right? And so that's what I think makes the most sense for a lot of these guys is like, okay, you focus on the business, you're
Yeah.
focused on the growing it, focus on the operations. Like, do you want to take your
Yep.
attention away from that and focus on a new operational skill set, which is involving and optimizing the
Yeah.
real estate? And
Yep.
or do you just want to partner with somebody, right? And so yeah, I think it makes sense to bring on a different group of investors, a different group of partners, and then you can still participate in the upside, and you can still focus
Yep.
on maximizing the growth of your dental business or your DSO or your medical or your vet consolidation business or whatever it is,
Yep.
while allowing other people to do the work. And then like, so what, for instance, what we
Yep.
do is like we can, like, for a lot of groups, like we'll go in, we'll develop or buy or invest, and we'll do a lease back or whatever, but then opening up the investment side to the doctors and to the partners and to the and to whoever, to allow them to essentially get that stickiness feeling, right? Like participate in the upside. So
Yep.
now they've got some skin in the game. Now they feel like they take ownership of the building as well. In addition to the operational side, it creates more
Yeah.
cohesiveness, more accountability, and more incentive to really produce well, because the value of the building is tied to like the credit of the tenant
It is.
and stuff like that.
Yeah.
And so, yeah, if you got if people can do it on their own, like, without taking on outside help, then great. Like,
Yeah.
and it doesn't detract from anything, great. But most of the time, it just seems like it makes more sense to really find the right partner more than anything.
Yeah. And I think as we look to some of the other specialties, take ophthalmology or orthopedics or some of the physician side that are going to have possibly their own surgery center. That play, there may be more justification, especially in bringing
Hmm.
on a partner, because some of those investments could be $5-10 million
You're talking about
to
the
build that out.
spoken hub or hub and
Yep.
spoken model.
Little hub and spoke, yeah. If they feed their own surgery center, I've seen some where we built clinics off of surgery centers. I mean, I have one I group that has done a tremendous job, single location, but for a few $1 million, built a beautiful real estate building on a very desirable location, and has already had a blind offer for $10.5 million for the building, based on what you just said, the quality tenant nature of how well the practice is doing. So not only does he have an incredibly valuable practice, but he also has a incredibly valuable piece of real estate. So when you start looking at those kind of things, I think that surgery center component really does create some different avenues for real estate. As we look at it, veterinary like to own their clinics. If they're going to own some ranch land, if they're doing, big equine, then you definitely have a different dynamic as well, as you typically don't, lease that land or whatnot. So there's definitely some good avenues as we think just a dental though, or maybe even single, physician practice. That's where we've seen a little less real estate ownership.
Yeah,
So
yeah, and it makes sense. Like if it's going to limit you, you don't want that. But you can. There are ways to do it. Participate. I think what happens is a lot of times it's just FOMO, right? Like they see that other people
yeah,
are
yeah,
buying real
yeah,
estate, and they don't realize that their business is producing more than that real estate, but they just don't want to miss out, and they want to try and capture everything. And so, like, when you take a logical look at it versus an emotional one, it doesn't necessarily always make sense. But yeah, there's always ways to do it, right? Just the book. You're
yeah.
familiar with the book Who Not How? Okay.
No, I haven't. Oh, well, I feel like I've
It's
heard of
just
it, but I
about
haven't
finding
read
the
it.
right people to help you, finding the right partners, finding the right
Okay.
employees, finding the right whatever. And like,
Yeah.
yeah, I think you ultimately like that's the way. Like for us, we don't want to do
Yeah.
dental, right? We don't want to own a dental business. We don't want to own
Yeah.
a
Yeah.
veterinary office. It's like, we know
Right.
our core competency and we focus on it. And so it's just the flip side of
Yep.
that. But yeah, I think it is smart to figure out a way to get exposure to that for sure. To get exposure to the real estate side of things is definitely a smart
Yeah.
thing to do if you can do that. And I think it's worth exploring, investigating how to figure that out at the end of the day. So,
Yeah.
what about,
I
okay, I have
agree.
like a multi-layered question.
All right.
We talked about where the industry is not going, which is 100% consolidation, but where do you see the industry going, and how does the macroeconomic framework play into that?
Dentistry coming out of COVID was so resilient, right? So many people, and that was even the messaging on this client call I referenced earlier this morning. Coming out of COVID, there was pent up demand. There was a lot of excitement getting back to doing some normalcy. And even if dental appointments were normal, they also had things they didn't get taken care of in the normal course of life and business cavities and crowns and all that fun stuff that had to be taken care of. But I saw that pent up demand, and everybody saw it as well on the market side. So it created this incredible opportunity and buying frenzy. You had sellers or people that were on the fence whether they wanted to sell or retire now versus 3 years from now, thinking I'm out, I'm tired. I went through some of the hardest time of my life. And making sure my employees were paid for or laid off or paid or a PPP, an idle, an ERTC credit, all these different acronyms that they lived through. And then, the market's saying, wow, they came back and bounced back immediately. So even in the hardest times, this is still an incredible asset. So what's that led to is we've been a part of about 150 mergers and acquisitions this year
Well,
alone, and the year's not over. It's been, we're a 7,500 employee firm, and DSO consolidation has represented 1/3 of all the transactions we've been a part of across all the industries that we serve. So it's been a fever pitch on that. So as I look to 2022, there are a lot of deals that aren't not going to get done in 2021 that are already getting pushed to 2022, Q1, Q2 into next year. And so I see that pent up demand continuing. If we think about who the buyers are, a lot of them, they'll get a 5-year commitment of capital. And I know this
mhm.
happens in the real estate world too. Like, hey, I have an investor, I've got their capital for 5 years, I got to give them X return over that period of time. But most of them didn't deploy capital in 2020 because they didn't know what was going to happen. So now they have 4 years to deploy 5 years worth of capital. And that's why we have so much aggression right now and trying to pick up that demand they lost in the last year. So it's making things appetizing. Groups that, 3, 4 months ago told me they didn't want to sell for 5 to 7 years or calling me, literally this happened yesterday, calling me, wanting to talk to investment bankers I know and start having conversations. And I'm like, what happened to the last time we chatted a couple months ago? You didn't want to sell it right now. So it's back to that FOMO conversation you mentioned a bit ago.
Yeah. So there's a lot of people who are screaming, the sky is falling. They say that we're due for an economic recession
Hmm.
because it's
Yeah.
time, right? Just there's,
Yeah.
they just simply say because it's been a long time since the last one, therefore we are due for a new one.
Yeah.
Do you think there's any validity to that? And like, do you see any indicators that that could be the case, or like I mean, like, because it sounds like
Yeah.
from what you're seeing in this, that everybody's very optimistic and very bullish on the future in the healthcare
Yeah.
space. Do you think the healthcare space is just immune, or do you think people like? I mean, what's your
It's a great
perspective?
question. I think the hardest thing that we're going to start seeing, all the articles I'm reading, I'm sure a lot of them you're probably doing the same, is a great employment shift, right? A lot of folks that are not wanting to get back to work, not wanting to go through the grind, and it's not as important as it once was to them. The unemployment rate or unemployment open jobs right now is 11 million, 11.1 million open jobs across America right
Wow.
now. And you hear time and time again, my assistants in hygiene are costing me 50% more than they used to because I can't get more back. So you hear that conversation time and time again as we look to Asia, similar things are happening. So, when I look at the concern, there's a lot of demand and a lot of pent up demand and a lot of different facets. If we look to, retail, automobiles, vehicles, power sports, motorcycle, dirt bikes, all those fun things I have a passion for, you start seeing that they're 18 to 24 months on supply chain is everything they're saying before things will be normal just on getting that back. Well, that's creating an inflationary or creating a environment where people are wanting to buy and make sure they have their next vehicle for the last one that broke down, even though they don't really need to buy right now or whatever it may be. So we're still seeing a lot of demand on the retail side and some vehicles. What I ultimately worry, we're on the tail end now where most of the stimulus money is running out. A lot of those ERTC credits, even that was done now at the third quarter of last year or this year. People still have time to apply, but they stopped doing that as another quarterly thing. You start seeing the stimulus come out. It'll be interesting to see at the tail end of 2022 how the economy still holds if we still, do really well. I think in the healthcare space, we will continue to do well. I mean, if we look at dental today, I mean, just taking dental, what is it? Only a third of America regularly goes to the dentist. So you still have a huge demand, and opportunity to capture patients that weren't going to the dentist. Um, and I think that that's the opportunity on a healthcare side. We still have a lot of folks on the aging boomer side that are going to need their physicians, are going to need surgeries, are going to need, care. And I think those are critical things that we all look to. But, if we look 3 to 5 years, are we due for a recession? I mean, like you said, economics will tell you, but I don't see, or I'm not hearing from any advisors I talk to fairly frequently. I'm not hearing any demand pullback from the bankers over the next 12 to 18 months. They think they're going to continue at the same pace they've been going for this last 12 months.
Yeah, yeah, that's what I think too. I think that because this time is just not a good argument, it kind of has happened
Right.
historically in that amount of
Yep.
time, but there's, it's like, where is it going to come from? Like, what data do you have to support that?
Yep.
Like, what is
Yep.
scary, like, that you're looking at right now? I mean, yeah, the only thing I can see
Yeah.
is the employment thing, but can that be offset by
Yep.
the exponential age that we're in with productivity gains and
Automation,
and all those
technology.
types of things, right? Like, I don't know. So, yeah, I kind of agree
Yeah.
with that. So, yeah. Lastly, any books or podcasts that you recommend?
Yeah, no, great. I wish I read more. You asked me the question on the books earlier. I wish I read more than I do. When I tend to read, since it's so much news and articles and relevant data, and of
Yeah,
course, several hundred emails a day, it feels like,
right.
it tends to be the Jane Pattersons of the world, and some simple things like that, where you can just kind of get lost in the book or whatnot. But, what I've seen in the dental industry and a lot of healthcare, EOS, traction, rocket fuel
Yeah,
seems to be a very common messaging. So I made sure I read all those books so I could speak the language, understand it. I sit on some people's, weekly meetings, if you will, and really try to get into it with them on that side. So I really like that side. One of my first business books was Who Moved My Cheese,
okay.
which I thought was so relevant, and that stuff. Podcasts, I've actually just, I say I'm just now the guy getting into podcasts. So on my workouts in the morning, whether it be Tim Ferris or DSO Secrets or some random murder crime thing. I love Dateline and 2020 stories, so I
That's
tend to
funny.
gravitate towards those,
Yeah,
awful
I
stories.
like Tim
So
Ferriss
yeah.
too.
What about you?
With Tim Ferriss, Joe Rogan, I go
Yeah.
through spouts where I listen to a lot, and then I just don't listen to
Yeah.
any because
Same.
it's entertaining, and there's
Yeah.
some real world practicality and some life benefit, but not always, and so it's like kind of like
Yeah.
it's a blend. And then I've been listening to What Is Money? It's this podcast that just talks about
Okay.
like all the money printing that we've done. It values, does things like compares democracies to monarchies. Looks at it evaluates
Interesting.
cryptocurrencies, and it tries to really say
Yeah.
what direction are we headed. So that's a cool one too. Yeah, it kind of changes.
Yeah.
I used to
That's
listen to a lot
cool.
of Bigger Pockets,
Yeah.
Which is like all about real estate. So it's like whatever,
Right.
I'll go in, like I'll go all in. I'll get really super hyper focused on it,
Yep.
and then all of a sudden something will switch, and I'll be like, like I don't want to like.
Yeah.
It's like redundant or repetitive, and I feel like maybe
Yep.
I know it, or it's just I don't know. Time
Need
for
something new.
else.
Yeah, new
Yeah,
challenge, new knowledge base. Yeah,
yeah,
I got into family office stuff for a while because a lot of our clients were setting up estates and foundations. So I got really hyper focused on family offices, and yeah, then it was just one of these days like, all right, okay, I've heard about it. Like, great,
yeah,
cool. So
yeah. What's a good way to get in touch for anybody who's wants to reach out and learn more?
Yeah, emails is always great. I anally email, anally responsive, as far as it's something I pride myself on is communication. And when you deal with an industry that says, hey, I don't hear from my CPA for months at a time, then I want to be overly attentive. Phone number 469-974-6693. We can, publish this on the screen, and of course my email address.
Yeah, I'll write
And
that
then,
down. What's the email
okay,
address?
mike.white at claconnect.com.
Cool. We'll put both
CLACONNECT.com.
those in the show notes, but just in case anybody is listening
Yeah,
and they just want to
perfect.
write it down. Okay.
Yeah, perfect.
Well, great. Hey, this has been awesome. Thanks so much for your
Yeah,
time.
I appreciate it.
Yeah,
No, I appreciate it. Happy holidays. I'll get you connected to Ben, and we'll talk soon.
absolutely.